Today is Monday, September 29th, 2008, and this is Brian Shannon from AlphaTrends.net. I'm back from vacation and was looking through charts yesterday and saw a bunch of devastation. And, this morning on the blog, I had posted this chart right here about 24 minutes after the market opened. It said in the title, collapse question mark. Sure feels like it, be very careful. NASDAQ looks like it's headed towards the 50% retracement level, and that is of the 2002 lows up to the 2007 highs. 50% of that is right down here. Let's take a look at the day at that on the chart on the weekly. Actually, we've got to back up to the monthly time frame. Things are pretty dire when you have to go back to monthly time frames to look for potential support levels and that sort of thing. And I think we have a complete lack of confidence in not only the markets here but the politicians, and we've got a very fear-driven decline here today. The market made it down to $37.16, and you can see here that from these 2002 lows up to the 2007 highs in the NASDAQ, we had found support previously at the 38.2% retracement. And now this next leg lower is bringing us down towards this the 50% retracement, which is at about $37. Again, today we basically hit that target. And what we can do now is take a look at the measured move. The height of this move, if we take that and basically put it on right here, here's another reason to think that maybe this is where we begin to find support. But that's definitely not a reason to do any purchasing at all. In other words, the height of this move is basically about equal to the height of this move right here. The market is often symmetrical in those. We call that the measured move. But again, look at the 1 minute time frame. There is zero evidence that this market has begun to turn at all. So as much as you might think, well, there's the potential support has the word potential in front of it for a reason. It's not an area to buy. It's an area to look closely for the existence of new bids coming in, of shorts covering their positions, and that sort of thing. But right now, I'm looking at this market trading down even lower here in the after hours. I don't know if this chart's it might be moving too quickly, but I'm showing $36.80 is where this market is right now. So I don't know what the news was, but we just seem to have had some news here after the market close. And basically, again, I've been warning all year that we're in a bear market, and when the 50-day moving average is declining, any rally should be treated as guilty till proven innocent. There's no reason at all to be a buyer in here, and hopefully you were spared the devastation that a lot of people felt today. A lot of people look at this market and say it's oversold, it's down too much, that sort of thing. But on this S&P 500, it's just a classic downtrend, a bear market, lower highs and lower lows below all these declining moving averages. And it takes time to heal not only the damage financially in the market, but again, the confidence that people are going to have be able to place in the market once again. A lot of people have been hurt very badly and are basically unwilling to come back to a market where they've been lied to and mistreated over and over again, while the corporate executives and all the other scapegoats take all the blame. I don't want to make political statements here. Let's just stay focused on price. The S&P 500, from the point of its 2002 lows up to the 2007 highs, has sliced right through that 50% retracement level, and now the next potential area, and again, it's only a potential area where you look for maybe some support forming, but not a reason to purchase, is this area right in here near 107. That's what's a 2/3 retracement. It's also where we had seen some support build in late 2003, 2004. Looking at the shorter term time frames, we've still got a declining 5-day moving average. We've still got a big mess here. It's a bear market, and attempting to purchase in here, except for very short-term day trades, just doesn't make any sense at all. It's interesting to see that the volume wasn't as large in here today as what we had seen just a week and a half ago. As the market, the government said you can't sell short these 800 stocks. We had that initial Thursday, Friday rally. We gave those back last week, and now we're continuing lower. When the government tells you you can't sell something short, it's because they're scared and they're afraid of the implications that the short sellers will have, because there's so much other pressure on the market. But Again, we remain in a very volatile environment. I did some research over the last 10 years. When the market is above the 50-day moving average, the S&P 500, the average range for the day is about 1.2%. When it's below the 50-day moving average, the average range is 1.8%. So, in other words, about 50% more volatile in a downtrending market, as defined by a declining 50, or just actually, I didn't say the direction of the moving average because my technology wouldn't allow me to do that, or I haven't figured it out yet. But as it's below a 50-day moving average, it's basically about 50% more volatile. I'll publish that only on my blog, alphatrends.net, here in the next couple days. Let's take a look at some of these other markets. Oil, declining 50-day moving average, guilty till proven innocent. We saw a big rally, and big rallies occur in downtrends. That's the nature of markets, and we're seeing further decline there. And again, you can't look at oil and say, well, oil's down, so the equity should go up. Those relationships, the academic, relationships aren't always there. You have to trade what you observe in the market that you're trading, because that's the only thing that's going to pay you. So oil continues lower. Gold was up today about GLD was up $2.93. It's still kind of consolidating in here, really, and rebuilding from this breakdown in here. But gold was only one of the only areas where we had seen that flight to quality. We also actually the 13-week T-bill index was the yield got down to 4.5, or basically 45 basis points, as people are flooding money into 13-week T-bills. It's paying 45 basis points right now. Last week and a half ago, it got down to about 15 basis points. But there's a lot of fear, obviously. The VIX, a lot of people look at that and say, well, anytime the VIX is over 35, you buy, whatever. We're seeing all-time high readings in the volatility index. That's how much fear and panic there is out there. And when there's that much fear and panic, there's a lot of times opportunity. So if you're able to keep your powder dry, and if you can act very, very, very quickly and trade off these 1-minute time frames, a lot of times there's some very good opportunity for short-term day trades, only based on these 1-minute charts. But you can see here the SPY is trading down even further, down at 111.80 after the official 4 p.m. close for the SPY index. Financials, let's take a look there. Financials came up last week to a declining 200-day moving average. And when does this market make a bottom? It's going to take a lot of time for a real bottom. We need to see this 200-day moving average flatten out. We need to see it look like it did back in here in 2004. This is the way markets bottom out. The 200-day moving average, or 40-week moving average, flattens out. We get the 10-week and the 20-week and the 30-week above it. It breaks past a high, and then you have plenty of time to purchase and participate in the next uptrend. As long as that 200-day moving average on the weekly time frame is heading higher, you generally give, from an investor standpoint, you give the benefit of the doubt to the buyers. So the 3 key moving averages on a weekly time frame, you look at the 40-week moving average. If you're an investor and this thing's still declining, then you treat any rally as guilty till proven innocent. It means the big money is liquidating. On the daily time frame, you look at the direction of the 50-day moving average. It's basically flattened out. Okay, so that means neutral. Why on earth would you want to get involved in a neutral market? So it's more a waste of time, which has been my point on the financials for a while here. And on the shorter term, on a 30-minute time frame or a 10-minute time frame, look at the direction of the 5-day moving average. Those are 3 key moving averages for those time frames. I talk about other key moving averages in my book, available again only at technicalanalysisbook.com. Let's take a look now at the semiconductors. This group was down 8%. They're coming into those lows that we had talked about for several weeks. Here's where we are right now, and here's basically that's about where we were looking for the market to come down to, 23.5. Doesn't mean it's going to stop here or has to stop here, but clearly things are very bad out there. And unfortunately, a lot of times in a market like this, you have to take huge risks to get any type of reward. Don't fall for that. It's better to be on the sidelines wishing you were in than it is to be in the market wishing you were out of it.